You bought a stock. You did your research, you felt confident, you believed in the story. And then it went down. Or perhaps worse, it just did nothing. It sat there day after day, week after week, a monument to your apparent mistake, while other stocks seemed to be soaring. What's the natural feeling? Failure. You feel like you made a bad call, that you're not good at this. The impulse is to sell it, get rid of the evidence of your error, and try to find the next winner to make up for it. We are conditioned from a young age, in school, in sports, in our careers, that success comes from a high batting average, from being right more often than you are wrong. But what if I told you that in the world of long-term investing and wealth creation, this intuition is completely wrong? What if the most powerful wealth-building strategy in existence not only tolerates failure, but actually depends on it? Today, we are going to explore a strange and counterintuitive idea from Morgan Housel's The Psychology of Money, known as Tails You Win. It's the concept that you can be wrong most of the time, have the majority of your ideas fail, and still end up incredibly successful. Understanding this can change everything about how you approach your financial life. First, what is a tail? In statistics, a tail refers to the extreme ends of a distribution curve, the rare outlier events. A long tail means that while most events are clustered around an average, there are rare events at the tail end that have a massive, disproportionate impact on the total outcome. Think of it like this. Imagine you plant 100 seeds for a new type of oak tree. For years, most of them grow at a similar modest pace. A few might even die off, but one of them, due to a unique combination of soil, sunlight, and genetics, grows into a colossal, magnificent giant that towers over all the others. If your goal was to produce the maximum amount of wood, the outcome of your entire 100-seed experiment would be almost entirely dependent on that one single outlier tree, the tail event. The other 99 trees are practically irrelevant to the final result. This is exactly how many things in business, technology, and especially investing work. A few events drive the majority of the results. Let's look at the world of venture capital, the business of funding startups. VC firms invest in dozens, sometimes hundreds of new companies. They know with absolute certainty that most of them will fail. They will lose all their money on a huge percentage of their investments. They are constantly wrong, but they don't care, because they are not playing for a high win rate. They are playing to find one or two tail events, the next Google, the next Amazon, the next Uber. That one single investment that returns 1,000 or 10,000 times their money will pay for all the other failures combined and produce all of the fund's legendary returns. They can be wrong 95% of the time and still have spectacular success. This isn't just for venture capitalists. The same is true for the public stock market. The overall returns of an index like the S&P 500 are also driven by a long tail. A handful of super performers, companies like Apple, Microsoft, and Amazon, have grown so spectacularly that they are responsible for a huge portion of the entire market's gains over the last few decades. Most of the other 490-plus companies in the index have had much more modest or even negative results. The implication for you as an individual investor is profound. Your success will likely not come from picking 10 stocks that all go up 10% a year. It will more likely come from owning a diversified portfolio where many of your investments do okay, some do poorly, but one or two over the course of decades become those giant outlier trees that produce life-changing wealth. So, if this is how the math of wealth works, why is it so psychologically difficult for us to accept? Because we hate being wrong. It feels like a personal failure. We see a stock in our portfolio that is down 20%, and our instinct is to cut our losses. We see another stock that is up 30%, and our instinct is to take the winnings off the table before we lose them. But the long tail strategy requires the exact opposite. It requires you to endure the small losses from your mediocre investments as a normal part of the process. And crucially, it requires you to have the stomach to hold on to your big winners, even after they've already gone up a lot, to give them the time they need to grow from a big success into a truly gargantuan portfolio-defining tail event. Your biggest winner might look expensive after it doubles, But the tail event mindset understands it might still have another 10,000% to go over the next 20 years. This requires a fundamental shift in how you measure success. You need to stop thinking about your batting average, how often you are right, and start thinking about your slugging percentage. What is the magnitude of your outcome when you are right? A baseball player who strikes out most of the time but hits a grand slam every few games can be far more valuable than a player who hits singles all day. To implement this strategy in your own life, you need to cultivate 3 psychological superpowers. The first is patience. Tail events take a long time to play out. Compounding is a slow, quiet process for years before it becomes explosive. The greatest enemy of this strategy is your own impatience and the need to constantly do something. The second is diversification. Because it is impossible to know in advance which of your seeds will grow into the giant outlier tree, you need to plant a lot of different seeds. Diversification is your ticket to participating in the tail events. It increases the odds that you will own one of the rare super performers when they take off. And the third, and most important, is survival. You have to be able to stay in the game. You must structure your finances in a way that allows you to endure the inevitable market downturns and periods of poor performance without being forced to sell. Having an emergency fund, keeping your debt low, and managing your expenses, these aren't just good financial habits. They are the bedrock of the survival mindset that allows the long-tail strategy to work its magic over decades. So the next time you look at your portfolio and feel a pang of disappointment about an investment that isn't performing well, take a breath. Remind yourself that you are not playing for a perfect record. You are playing for the long tail. That underperformer is not necessarily a failure. It may just be one of the 99 trees that isn't the giant. And that's okay. Its purpose is to be part of a diversified forest that gives the giant the chance to grow. Stop striving for a portfolio where everything is a winner. That's an impossible goal that will lead you to churn your account, sell your winners too early, and give up in frustration. Instead, strive for a portfolio that can simply survive, because survival is what gives you the time needed for the powerful counterintuitive forces of the long tail to work in your favor. True financial success isn't about the genius of being right all the time. It's about the resilience to endure being wrong most of the time, so that you can still be in the game when the rare, extraordinary, and life-changing wins finally arrive.